Hi there, welcome to kneppyinvests. Goodman Group is a company I've heard a lot about over the past, say, 5 to 10 years. This is a company that many fund managers, many analysts say every single serious Australian investor should have in their portfolio. So I've decided to have a good look at this company to decide whether it belongs a position in my portfolio for the long term. Now, Goodman Group is considered a REIT by a lot of people. And after doing research on the company, I probably wouldn't classify it as a REIT. It is in that real estate space, but it's a lot more than just a simple REIT. And I'll discuss that in today's video. Also have a look at their financial year 22 results and just see whether this company belongs in my portfolio. At this point in time, Goodman Group is not a part of my portfolio. I do not own shares in this company. For some reason, I just want to call this company the Goodman Group, but it is just called Goodman Group. Now, the whole point of me doing these videos, doing research on a company, is just to decide whether a high quality company belongs to be a long-term hold in my portfolio. And these videos work really well for me because I do discover a lot of things about these companies. So hopefully you can take something out of this video today. Now, we already know that Goodman Group, by some people's consideration, by some people's opinion, this is a REIT, a real estate investment trust, and it is not. It is part of the business is like a REIT, but they're a whole lot more than just one of those REITs that is plentiful on the ASX. So Goodman Group owns and maintains high quality properties close to consumers, develop properties, and also manage properties. So develop properties and manage properties is something that is a little bit different than REITs. So REITs sort of own and operate their own property. And the main reason they own and operate their own property is to get rent from owning and operating that property. And that is a little bit different than Goodman Group. Now, the Goodman Group does have that part of the business, but they derive a lot of revenue from the management of other people's property and also the development of properties as well. Goodman Group is a global company, and they have or do manage a lot of properties throughout the world. So we're talking about Europe, UK with $11.9 billion assets under management, Asia, $22.8 billion assets under management. And this is taken from the annual report, which was released about 6 months ago. So this could be old information. Australia, New Zealand, $29.8 billion assets under management, and the Americas, $8.5 billion assets under management, with only 28 properties there. Occupancy rate, pretty high, 100% in Europe and UK, and only 96% in the Americas. And some of the cities they have property in include Amsterdam, London, Madrid, Milan, Paris, Beijing, Hong Kong, Shanghai, Tokyo, Brisbane, Melbourne, and Sydney, of course, including Auckland in Australia, New Zealand, Los Angeles, San Francisco, Sao Paulo. No, interestingly enough, they call New Jersey a city and Pennsylvania city. They are not cities, they are states. So a little mistake here in Goodman Group and a report calling two states cities. In their annual report, they also had a list of their top 20 customers by rent. And by far, the biggest customer by rent is Amazon, with 8.1% of their rent coming from Amazon. Then we have Deutsche Post, DHL, coming in at 2.5%, Equinix, 2%, BMW Group, 1.8%, JDoom, 1.5%. We also have Coles Group here, Global Express, DSV, Australia Post, Linfox, and also Woolworths. The current CEO of Goodman Group is Jason Little. He's been with the company for quite a few years. In fact, he's been with Goodman Group for 20 years, joining in 2003 as manager of capital transaction. That sounds like a very interesting position. I am being a little bit sarcastic there. He was appointed general manager in 2007 and then the CEO in 2021. So he hasn't been in this role for too long, but he has extensive experience in the property industry with executive roles at Grant Samuel and Paul Ramsey Holdings before he joined Goodman Group. Now, would I classify Goodman Group as a high quality or a low quality company? And one of the reasons I decided to do Goodman Group, just because all this chat I've heard about this company as a high quality company on the ASX, one of those companies that should be a part of every Australian investor's portfolio. It's not part of my portfolio, so am I making a mistake? So after doing a little bit of research on this company, I would trend towards this company being a little bit overrated. I might still say they are a high quality company, but I wasn't as impressed as I hoped I would be after doing the research. But I do think this company does belong in a lot of investors' portfolio, simply because it is into property and it's not quite a REIT. It's a little bit more diversified than just a REIT. So if I did have to pick between Goodman Group and a few other REITs, I probably would try to maybe trend towards having Goodman Group, or prefer having Goodman Group in my portfolio over other REITs. Now to the company's financial year 22 results. And if you did consider Goodman Group a REIT, this is by far the biggest REIT on the ASX. Second comes Scepter Group, SCG. They own Westfields Group. So the market cap of Goodman Group is $37.1 billion. That's at a share price of $19.70. I just looked at the share price now, because I am recording this video just on close of trading on March the 9th, which is a Thursday, and the share price closed at around about $19.62. Financial year 22 revenue, $2.1 billion. Now, when I did look at the financial year 22 financial statements, there's a lot of stuff happening with this company. So instead of looking at the reported profit, and the reported profit was something like $3.4 billion, which was more than the revenue. And you might say, how can the profit be more than the revenue? And it's all about the counting ways they deal with the increase in value of property. And because property increased in value during financial year 22, that was a good thing for the underlying, or the reported profit. But they did also report their operating profit, and the operating profit was $1.5 billion. So they did define their operating profit as profit attributable to security holders adjusted for property valuations, derivative and currency mark to market, and other non-cash or non-recurring items. So I probably would focus on the operating profit, which was $1.5 billion. Not really focus. Don't look at the underlying headlines in the paper saying that the Goodman Group's profit was $3.4 billion. Don't go to any website that has the profit for this company $3.4 billion, and then judge performance, judge the valuations of this company based off that profit, because you'll get a different and a fair different P ratio and valuation metrics than you would if you dig a little bit deeper into the results of this company. So hopefully that makes sense, and hopefully that explains why I prefer to use the operating profit of $1.5 billion than the reported profit, which was more than double that. Operating cash flow, $828 million, and free cash flow, $822 million. Now let's have a look at the three different segments or sections or divisions of this company, because I just want to know how much income or revenue this company gets from their three different divisions. So the first one here is their property, and property income comprises rental income under operating leases, net of incentives provided, and amounts billed to customers for outgoings like rates, levies, cleaning, and security. Nice increase in gross property income from last year to this year, increasing from 112 million to 138 million, but not like the total revenue this company receives overall. And the way I look at this gross property income is, if this company was simply a REIT, this would be their, maybe not FFO, but very close to their FFO. Now onto the development part of the business, and this is a little bit more complicated. So I did have to go through this a few times, because there are three different sides or ways they get revenue in the development part of the business. So they have disposal of inventories, development management services, and also fixed price development contracts. So in the disposal inventories, that income is recognized at the point in time when control over the property asset is transferred to the customer. The development management services is just fee income from services that include master planning, development management, and overall project management. But by far, most of the revenue, in fact, more than half of the revenue in this part of the business, the development part, comes through the disposal of disposal of inventories, 803 million. And overall, they get $1.4 billion of revenue through the development side of Goodman Group. Now, that revenue was a little bit down from last year, which was about 1.5 billion. Now, to the management side of the business, and this is just Goodman Group looking after or managing other companies' real estate or property, and nice growth in revenue over the past year, increasing from 384 million to 511 million. Now, let's have a look at the profit and loss statement for Goodman Group, because this is how you understand how this company had only revenue of about $2.1 billion, yet were profitable by 3.4 billion. And that was the reported profit, 3.4 billion. And you can see that number on the bottom of the profit and loss statement here. Nice increase from last year, $2.3 billion of profit that year. Now, I've already said the profit number I'm using is 1.5 billion. That's our operating profit. And we get that number in the first two sections of the profit and loss statement. So the first section is the revenue, which was 2.1 billion. So you add up the gross property income, the management income, and the development income, and then you take away the property and development expenses, which was $588 million. So if you detract that from the income or the revenue, you get $1.5 billion. And the way I look at it, that is their real profit for the business in financial year 22, the operating. And when I say real, I mean operating side of the business. So how do we get $3.4 billion in profit for financial year 22? And that comes in the next section down, other income. And this is all net gains from the fair value adjustments on investment properties and the share of net results of equity accounting investments, which was 2.7 billion. And I think a lot of that, haven't had a close look, but a lot of that was just adjusting the value of properties they have. Even last year, that amounted to 1.7 billion. So in my opinion, you do have to take that into account. And that's why I do prefer to say this company had a profit of $1.5 billion instead of $3.4 billion. Because if you say this company had a profit of $3.4 billion, and then you have a look at the valuation metrics, you probably see or think this company is severely undervalued at current valuations, and that's not necessarily true. Now, let's have a look at the revenue history for this company over the past few years. And this is from Ticker, T-I-K-R, and they're broken down the revenue here into property management fees, which is actually the development and also the property management combined together. For some reason, Ticker didn't separate these two sections. And then we also have rental revenues, which is sort of like the property income that I talked about previous in this video. So nice increase in property management fees, while rental revenues have gradually decreased through time. And if we look at the compound annual growth rate in revenue per share over the last 10 years, we get about 8%, which is nice, but I do prefer that to be at least 10% per year. Over the last 5 years, 3.5% per year, revenue has increased, or revenue per share has increased. And over the last 3 years, 5.3%. So probably the biggest red flag, not red flag, but the main reason I could argue this is not a real high quality company on the ASX is just we don't see that revenue per share growing at least 10% per year over the past 10 years. Doesn't mean that's going to continue in the future. Maybe this company can grow the revenue per share at more than 10% per year in the next 5 to 10 years. But at this point in time, history is suggesting they will have difficulty doing exactly that. And another thing I'm a little bit mindful of is the lack of growth in dividends over the past 4 or 5 years. We had a nice increase in dividends between 2013 and 2018, but dividends have been flat since then. Not only that, dividend yield is fairly low at 1.5%. So another reason I'm a little bit hesitant to call this a really top quality company on the ASX is just the lack of dividend growth over the past few years. Now let's have a look at some valuation metrics for Goodman Group. And remember, I used a profit of 1.5 billion instead of the reported profit of 3.4 billion. If you use that profit number of 3.4 billion and you calculated the P ratio, you'd probably get a number just above 10. I can tell you right now, if I saw Goodman Group with a P ratio of just above 10 using my own calculations, I could see myself taking a position in this company. So even though the growth in revenue per share is not quite as high as I would like to see, it's still growing, and a PE ratio of just above 10 would be a almost screaming buy, in my opinion. Price to operating cash flow, a little bit too high as well, 44.7. Probably should also mention a PE ratio of 24.7 for Goodman Group. Even though it's quite a bit higher than 10, I do think it's a little bit stretched for Goodman Group based off the earnings and revenue growth this company has experienced over the past 10 years. And that's definitely true for the price operating cash flow at 44.7. That's quite a bit higher than I would like to see. Also did a reverse DCF. So this is based off the earnings per share using a profit of 1.5 billion, not 3.4 billion. And I got 15.1%. So that means to justify the current valuation, Goodman Group would have to increase their earnings per share at 15.1% per year over the next 10 years. And I do think that this company will struggle to get to that number. Probably what I should have said there was, and I do think this company will struggle to hit that sort of growth rate per year, 15.1% per year. Now onto the charts for this company. So we'll look at the weekly chart here. Next slide, the daily chart. And between 2014, the start of this particular chart, and 2022, this is an absolutely stunning chart. And during that period, there were favorable macroeconomic conditions for Goodman Group to thrive. So in that period, that 8-year period, we did see decreasing interest rates. And that's the sort of environment you'd love to be an investor in this sort of company. But since the start of 2022, in fact, since June 2022, we have been in a sort of macroeconomic environment that's not good for Goodman Group. That means rising interest rates. And I didn't look at the debt for this company, but these are sort of conditions that are not conducive for good financial performance for companies like this. And that's why the share price has fallen. In fact, the share price was in a well-defined downtrend. I'll talk about that in the next slide, but that downtrend has broken and did break towards the end of last year. But then right now, the share price is just meandering around. Now, during this 9-year period, there's only been 2 times the share price of this company has fallen below the 150-week moving average. The other time was during the COVID-19 financial panic. If you take that away, for the majority of this period, this 9-year period, the share price has been moving up. Now the share price is struggling, and it's struggling to stay above that long-term moving average. So I do think unless we start to see interest rates decreasing, I do think the macroeconomic environment will see Goodman Group struggle to really outperform the market. And I think the market had the same opinion of me, particularly during 2022, because Goodman Group share price was in a well-defined, nice downtrend. Share price moved from $27 at the height towards the end of December, in fact, the 1st of January, or not the 1st of January, but the first trading day of January, all the way down to a low of just above $15.50 back in October of last year. And I think the reasons for that was just the rising interest rates. And even though interest rates didn't start increasing in Australia until June, if I remember correctly, the market was expecting interest rates to rise. But it does look, based off the breakout of the share price in Goodman Group from the downtrend line, and that downtrend line is portrayed by the sloping dashed line. So every single time the share price meets that downtrend line, the share price pulls back. The last time the share price went to that downtrend line, it actually went above. That was back towards the end of November, start of December. Share price went down again, but then share price started to rise. And there is potential that the sentiment in this company has shifted to more neutral to positive, and also potential the share price is trying to move into an uptrend. The last high we saw at the start of February was $21. So we have seen the share price pull back. Now, the next thing we'd like to see is the share price to move above $21 to get to a higher high. So we need to see that higher high. I think potentially we have seen a higher low, but we are possibly seeing a new uptrend developing in Goodman Group's share price or shares. I plan to continue this Kneppy's analysis series for a while yet, maybe forever, who knows. And the next 5 companies I'll be featuring in this series include Centuria, which is a REIT. That will be my next video. Also have a look at Dicker Data, because the share price has absolutely tanked over the past few months. Index, a company which I think could be transitioning, possibly transitioning from a low quality company to a high quality, but I'll talk about that in my video. Macquarie, so this is another one of those cult stocks on the ASX. Everyone loves Macquarie, so I'm going to have a sort of a look at Macquarie to see whether that cult-like status is justified. And also Supply Network, a very interesting company on the ASX, a beautiful looking chart, beautiful financial performance from that company. And I did a little bit of research on Supply Network, and I was pretty surprised to see a possible high quality company, not only in the making, but I think it's already got there. And I think a lot of the market is absolutely missing at this point in time. I'm not a holder of that company, but I am thinking if we see a significant pullback in the share price, I will become a holder of that company in the future. That's all I have for this Kneppy's analysis look at Goodman Group. So even though I came away a little bit less than impressed, particularly compared to those fund managers, those analysts who absolutely love this company and who believe this company belongs in every single Australian investor's portfolio, I didn't come away thinking that as I did the research on this company. If you disagree with me, and if you think this is a really high quality company, I'd love to hear your thoughts. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.